$121.62. That was the price of silver on January 29th, 2026, the highest it had ever traded in all of recorded human history, breaking a record that had stood since the Hunt brothers tried to corner the market back in 1980. And within 72 hours of hitting that number, silver was trading below $70, 43% gone in 3 days. And I need you to understand something before we go any further. That crash did not happen because the market decided silver was overvalued. The documents show exactly what happened. There is a paper trail, official CME Group advisories, margin requirement filings, position data, timestamp records. And when you line them all up in sequence, what you see is not a market correction. What you see is a controlled demolition. And the people who got demolished were you, me, and every other retail trader who wasn't sitting in a boardroom at the Chicago Mercantile Exchange. By the time this video is over, you're going to understand the exact mechanism that was used, the historical precedents that prove this was not random, and what it means for where silver goes from here. Because here's the thing. We're sitting at $84 today, February 22nd, 2026. The story isn't over. It's just entering its next chapter. So let's start at the beginning. To understand what happened, you need to understand one tool, one lever that the CME has always had access to and has always used at specific critical moments in market history. It's called a margin requirement hike. Now, if you're not familiar with how futures markets work, let me give you the 30-second version, because this is the foundation of everything that follows. When you buy a silver futures contract on the COMEX, which is the commodities exchange operated by CME Group, you don't need to put up the full value of that contract. A standard silver futures contract represents 5,000 ounces of silver. At $121 per ounce, that's a $605,000 position. But you don't need $605,000 in your account. You only need to post what's called a margin, essentially a good faith deposit. For most of 2025, that margin was around $22,000 per contract. So for $22,000, you could control $605,000 worth of silver. That's roughly 27-to-1 leverage. Now here's what happens when the exchange decides to raise that requirement overnight. Suddenly, your $22,000 isn't enough. You need $32,500, or they close your position for you. Automatically. No phone call, no warning, no choice. Your trade gets liquidated at whatever the market price is at that exact moment. And if enough traders get liquidated simultaneously, the selling cascades. The price drops, which triggers more margin calls, which creates more liquidations, which drops the price further. It's a self-reinforcing spiral, and the exchange has a button that starts it. Here is the documented timeline. I'm going to walk you through this slowly because the speed of what happened is the evidence. On December 12th, 2025, CME Group raises silver margins by 10%. Silver is trading around $32 per ounce at this point, and it barely notices. Then silver starts going parabolic. By December 26th, it's cracked $65. The CME issues advisory number 25-393. That's a public, verifiable document, raising the maintenance margin for March 2026 silver contracts from $22,000 to $25,000 per contract, a 13.6% increase. Silver ignores it and keeps climbing. 4 days later, December 30th, the CME strikes again. This time they raise margins by 30% in a single announcement, bringing the initial margin requirement to $32,500 per 5,000-ounce contract. In the span of 1 week, the capital required to hold a standard silver position had increased by nearly 50%. Silver hits $84 in late December and then pulls back. Into January, it recovers and starts climbing again, hard. By January 14th, it's above $93. By January 22nd, it's pushing $110. By January 28th, it's at $121.62. And then CME does it again. On January 28th, they switch from fixed dollar margin requirements to percentage-based margins, initially set at 11%. 3 days later, January 31st, they raise that percentage to 15%, and for high-risk accounts, it goes to 16.5%. Let me put that in dollars for you. At $121 silver, a 15% initial margin on a 5,000-ounce contract means you need to post $90,750 per contract. That is 4 times what traders had been required to hold just 6 weeks earlier. Positions get obliterated, not because the market decided the price was wrong, because the rulebook changed while everyone was still playing the game. Quick pause here, because if you're not subscribed yet, my analytics tell me about 3 out of 4 people watching this right now haven't hit that button. If this kind of breakdown, going through actual filings and documents rather than just speculating, is cutting through the noise for you, hit subscribe. It helps the algorithm surface this content to people who need to see it, and it helps me know who the committed community is. Now, let me show you why this timeline isn't a coincidence. Because the CME has done this before. Twice, in fact, in situations that look almost identical to what just happened. And if you know the playbook, you can see it coming. Let's go back to 1980. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, had spent years accumulating physical silver and silver futures contracts. At their peak, they controlled somewhere between 100 million and 200 million ounces of silver, roughly a third of the world's entire above-ground supply at the time. Silver had gone from $6 per ounce in 1979 to nearly $50 per ounce by January 1980. And then the COMEX did something it had never done before. They introduced what they called Silver Rule 7. This essentially eliminated the ability of any trader to hold a net long position beyond a certain threshold. And simultaneously, they raised margin requirements so aggressively that the Hunt brothers, who were some of the most powerful commodities traders in the world, couldn't meet the calls. Silver crashed from $50 to $11 in 8 weeks. The Hunt brothers eventually filed for bankruptcy. Paul Volcker was raising interest rates at the same time, which added to the pressure. But the mechanism that broke the price was the exchange's own rule changes. That's documented history. Now jump forward to April 2011. Silver had just completed one of its most spectacular rallies in modern history, going from $18 in August 2010 to $49.51 on April 28, 2011. And the CME Group, same institution, different century, implemented 5 separate margin hikes in just 9 trading days. 5 in 9 days. By May 12th, silver was at $33, a 33% crash driven almost entirely by forced liquidations triggered by margin calls. The fundamental demand for silver hadn't changed. The industrial use hadn't changed. What changed was the cost of holding a leveraged position on a CME-regulated exchange. And now, here we are in 2026. Same exchange, same tool, same pattern. The only thing that changed is the scale. Now I want to talk about something that makes the 2026 situation distinctly more alarming than either 1980 or 2011. And it has to do with what was happening in the physical silver market underneath the paper crash. According to COMEX data, between early and mid-January 2026, in just 7 days, 33.45 million ounces of silver were physically withdrawn for delivery from registered vaults. That is not a rounding error. That is 26% of COMEX's registered inventory disappearing in a single week. Now let me put that in context for you. At various points in 2025, analysts were estimating the paper-to-physical ratio on COMEX was approaching 356 to 1. That means for every 1 physical ounce of silver sitting in a registered vault, there were 356 ounces of paper silver being traded. 356. And people were starting to ask for the real metal. The Shanghai silver premiums, that's the price of physical silver traded in China versus the COMEX paper price, were running $5 to $8 above the New York price throughout early January. By December 24, 2025, the Shanghai premium had hit $8 over London prices, described at the time as the widest spread on record. Think about what that tells you. If paper silver and physical silver represent the same thing, their prices should match. When physical trades at an $8 premium over paper, it means the people who actually need the metal, who can't accept a cash settlement, are willing to pay significantly more than what the futures market says it's worth. That's not a market functioning normally. That's 2 markets telling you 2 completely different stories. And then something happens that I want you to really sit with. On February 5th, 2026, silver is in the middle of this massive crash, already down from $121. And during the Asian trading session, in a 30-minute window between 11:20 and 11:40 a.m. New York time, silver collapses another 17%, from $90 down to $75 per ounce. 17% in 30 minutes. But here's the part that got flagged by market structure analysts afterward. During that exact 30-minute window, the lit volume on COMEX dropped by approximately 80% compared to the preceding 10-minute average. I want you to think about that. Price falls 17%, while visible trading volume drops 80%. In a normal market, a 17% move happens on massive volume. Panicked sellers pouring out, opportunistic buyers stepping in, price discovery happening in real time. What was described in the trading data was the opposite. Price moving violently with almost no visible activity. Then, once silver bottomed around $75, a massive block of roughly 8,000 contracts was printed to the tape, the equivalent of 40 million ounces of paper silver, but printed after the fact, thanks to the legal allowance for dark pool trades to report with up to a 15-minute delay. What that data pattern describes, and I want to be precise here, this is market structure analysis, not proof of illegal activity, is consistent with institutional accumulation being hidden from retail participants in real time. The retail traders saw no volume, assumed the floor had fallen out completely, panic sold, or got margin called out of their positions. The institutions filled their bags at the bottom. Then the volume bars appeared on everyone's chart retroactively when it was too late to act on that information. Now here's where it gets worse, and I mean considerably worse. According to reporting from the Silver Institute, global silver demand in 2024 reached 1.17 billion ounces. Mine supply covered roughly 670 million ounces. That means there was a structural deficit of approximately 500 million ounces in a single year. And that deficit has persisted for 5 consecutive years. 5 years in a row. The metal is not being produced fast enough to meet demand. And demand is only growing because every solar panel uses about 20 grams of silver. The solar industry alone consumes nearly 30% of total global silver demand, and EVs use between 25 and 50 grams each. AI data centers are now a meaningful silver consumer for semiconductor production. This isn't speculative future demand. This is locked-in, contracted, structural demand that isn't going anywhere. Meanwhile, on January 1st, 2026, China, which controls somewhere between 60 and 70% of global refined silver production, implemented a new export licensing system that restricts overseas silver sales to large, state-certified producers. Think about the timing of that. The world's largest silver producer restricts exports on the exact same day that COMEX's paper market is in the middle of the most aggressive margin hike cycle in the exchange's modern history. Whether that timing is coordinated or coincidental, the effect is the same. Less physical silver available globally at precisely the moment when the paper price is being hammered down. Samsung, yes, the electronics giant, finalized a deal in October 2025 through a subsidiary to provide a $7 million prepayment offtake facility to Canada's Silver Storm Mining, securing exclusive rights to 100% of the mine's silver output for 2 years. Samsung didn't go to the COMEX to buy paper silver. They went directly to a mine in Mexico and locked up the physical supply at the source. Apple, Tesla, and semiconductor manufacturers are increasingly doing the same thing. Vertical integration of silver supply, bypassing public exchanges entirely. When the biggest industrial consumers decide they can't trust the public market to actually deliver physical metal, and they start going around it, that tells you everything about what they think is really going on. Let me now walk you through the specific documents that support what I'm describing. Because this isn't speculation, this is filed paperwork. CME Group Advisory 25-393, issued December 26, 2025. Public record, you can look it up yourself on the CME website. Raises maintenance margin from $22,000 to $25,000. CME Group then issues a second advisory, December 30th, raising the requirement to $32,500, a 30% single-session increase, the exchange's own language describing it as based on a normal review of market volatility to ensure adequate collateral coverage. January 13th, CME shifts entirely to a percentage-based margin system, initially set at 9%. Then January 28th, raised to 11%. Then January 31st, raised again to 15%. High-risk accounts hit 16.5%. The CFTC, the Commodity Futures Trading Commission, which is the federal regulator supposed to be watching all of this, had its weekly Commitment of Traders reports suspended for 43 days because of the government shutdown that coincided with exactly the period of sharpest price gains in the silver market. 43 days where the public couldn't see the positioning data that would show who was holding what, who was short, who was long, how the large commercial traders were positioned. When the reports finally resumed in early January, according to analysis by TF Metals Report, the swap dealers, the category that includes the major bullion banks, were still sitting at net short 232,242 COMEX gold contracts as of December 23rd. For silver, the equivalent positioning showed swap dealers net short, while price had risen 57.7% in just 12 weeks. They were holding short positions against a bull market, while retail traders were long. Then comes the margin hike cascade. The retail longs get forced out, the shorts profit. Let me show you the disconnect that shouldn't be possible in an honest market. February 5th, 2026. Paper silver, the COMEX futures price, is collapsing, 17% in 30 minutes. Meanwhile, physical silver dealers are reporting record premiums. Bullion dealers worldwide, APMEX, JM Bullion, Sprott, local coin shops, are charging 15 to 25% over the paper spot price for actual silver coins and bars. Because they can't get the metal. The supply isn't there at the paper price. If the paper market crash was reflecting real-world supply and demand, the premiums at physical dealers would have collapsed too. More supply chasing the same buyers means lower premiums. Instead, premiums exploded, because physical silver and paper silver are not the same thing. One is a promise, one is the metal. And when you look at the data from this event, paper price cratering while physical premiums surge, one of those markets is lying about supply and demand. And the physical market is the one you can hold in your hand. Now I want to talk about the mathematical argument that this couldn't have been random. Because it's one thing to say the timing was suspicious. It's another to look at the probability of these events lining up the way they did. In the entire modern history of silver futures trading, going back 50 years, there have been exactly 3 instances where the CME implemented emergency margin hikes more than twice in a single calendar month. 1980, when the hunts were being broken. 2011, when the silver bull market was being topped. And December 2025 through January 2026, 3 times. All 3 times, silver was in the middle of a historic bull run. All 3 times, the margin hikes preceded massive price crashes. All 3 times, retail traders, who had entered late, who were using leverage, who couldn't meet the new margin requirements, were wiped out. And in all 3 cases, once the retail positions were liquidated and the price had crashed, silver eventually resumed its structural uptrend, driven by physical demand. After 1980, silver traded sideways for years, but the industrial demand never disappeared. After 2011, silver dropped to $14 by 2020, but it didn't stay there. It came back to $50 by 2020, and it's now been above $80 for weeks. The paper crash doesn't change what silver is, it changes who owns it. So what does this mean for you, specifically, right now, on February 22nd, 2026? First, if you were trading leveraged silver futures through the crash, if you got margin called out of a position you believed in fundamentally, I want you to understand you weren't wrong about silver. You were caught in a mechanism that's designed to extract capital from leveraged retail traders at critical market moments. That's a structural problem with futures markets, not a judgment on your thesis about the metal. Second, silver is sitting at approximately $84 per ounce today, down 31% from its $121.62 all-time high on January 29th. This is not conspiracy theory. This is documented fact. Every previous margin hike-induced crash in silver has eventually been followed by price recovery to and beyond the previous peak. That doesn't mean tomorrow, that doesn't mean next month, and this is not financial advice. But the structural deficit, 500 million ounces per year, 5 years in a row, doesn't go away because the CME raised margins. China's export restrictions don't go away. Samsung securing mine output directly doesn't go away. The solar panels, the EVs, the AI semiconductors, that demand doesn't go away. Third, the distinction between physical silver and paper silver has never mattered more than it does right now. The $8 Shanghai premium over COMEX during the peak, the record premiums at physical dealers during the February crash, the 33.45 million ounces withdrawn from COMEX vaults in a single week in January, all of this is telling you that people who need actual metal are paying more than the futures price to get it. If you're holding physical silver, you are holding a different asset than someone holding a silver futures contract or even an ETF. The ETF can settle in cash. Physical can't. Fourth, watch the CFTC Commitment of Traders reports. They're publicly available every Friday. Watch the commercial short position in silver. Historically, when the commercials begin to reduce their net short position significantly, it precedes major price moves. That data is public. Use it. Fifth, watch the COMEX registered inventory numbers. When that number drops towards 0, when physical withdrawals begin to strain the system's ability to make delivery, the paper game gets increasingly difficult to sustain. The number had fallen approximately 70% over 5 years before January's delivery demands hit it hard. And sixth, and I say this as someone who's watched these markets for a long time, be very, very careful with leverage in silver right now. Not because the fundamental case is weak, but because the CME has now demonstrated in real time, in 2025 and 2026, that they are willing to change the rules mid-game in ways that can wipe out a leveraged position, even when your directional thesis is correct. If you want silver exposure, the physical metal carries no margin calls. no forced liquidations, no counterparty that can change the rules on you overnight. There's a reason Samsung bypassed the COMEX entirely and went straight to a mine in Mexico. And as always, I'm not a financial advisor. None of this is financial advice. This is analysis for educational purposes. Do your own research, make your own decisions. Let me bring this full circle, because I want you to walk away from this video understanding exactly what happened. On January 29th, 2026, silver hit $121.62 per ounce, the highest price in human history. What should have been a triumph for everyone who understood the structural case for silver, the deficit, the industrial demand, the monetary hedge, turned into a catastrophe for retail traders. Not because the thesis was wrong, but because CME Group used a tool they've used before, in 1980 and in 2011, to force leveraged retail positions into liquidation at the worst possible moment. The margin hike timeline is documented in their own public advisories. The CFTC's monitoring was suspended for 43 days during the critical window. The physical market told a completely different story than the paper market. The Shanghai premium hit record levels while COMEX paper prices crashed. An institutional dark pool buying was printed to the tape after the price had already bottomed, after retail had already been shaken out. The people who didn't see this coming in 1980 lost everything. The people who bought physical silver in 2020 when it was at $14, after the 2011 crash, after the years of manipulation, made extraordinary returns. The question isn't whether the story of silver is over. The question is what form your exposure takes, and whether you'll be holding paper the next time the exchange decides to change the rules. The signs were there in December. The margin hike started. The Shanghai premium spiked. The COMEX inventories were draining. And most retail traders were looking at a price chart going up, not at CME Advisory 25-393. Drop a comment and tell me, did you hold through the crash? Did you get margin called out? Or did you have physical and sleep through the whole thing? I read every single comment. Your experiences are genuinely valuable, and they shape what I cover next. The community here is some of the most informed precious metals analysis on this platform, and your input matters. If you haven't subscribed yet, if this breakdown of actual exchange filings and position data is giving you a framework that the mainstream financial media isn't, hit subscribe. That's how I know who the committed people are. It helps the algorithm show this to the people who need to see it. Next video, we're going to go deep on the COMEX March delivery deadline. February 27th is the first notice day for March 2026 contracts, and open interest is still running significantly higher than registered physical inventory. That story may not be done. Be ready.